All right, my friends, I've had a number of emails lately inquiring about how to avoid the 10% early withdrawal penalty. So let's dive right into the IRS website here. I'll put a link in the show notes. This is from irs.gov. You can see it right there, irs.gov. So we're not looking at the balance or KITSIS or anything like that. We're going straight to the source. All right, so retirement topics, exceptions to the tax on early distributions. Most retirement plan distributions are subject to income tax and may be subject to 10% early withdrawal penalty. Generally, the amounts an individual withdraws from an IRA or retirement plan before reaching age 59 and a half are called early or premature distributions, and you must pay a 10% early withdrawal tax unless an exception applies. Exception to the additional tax right here, all right? The distribution will not be subject to the 10% additional early distribution tax in the following circumstances. Qualified plans, 401k, etc., IRAs, IRC sections. All right, so you can see here is the 72T2AI. 72, Tango, 2, Alpha, I, India. I should have said it like that. 72T2AI, we're going to quiz you on that later, and the I is lowercase. All right, so look, we're going to look at two different ones, IRAs and qualified plans. All right, so again, 59 and a half, you have an exception. That's what that yes means, there is an exception. Corrective distributions, death is an exception. You die, your heirs can have access to your plan without penalty. Disability, as long as you follow the disability rules, which are actually somewhat lenient. Qualified domestic relations order, i.e. a divorce, that's an exception. And IRA says not available. That is weird. I wonder why it says not available there. That's odd. Qualified higher education expenses and 401ks, defined contributions, which are ERISA plans. The answer is negative, or niyet, as us Putin puppets say. For you Bidenites, they'll say, come on, man. But you can have qualified higher education expenses for IRAs and whatnot. Equal payments, series of substantially equal payments, yep. ESOP, dividend passer, yep. Home buyers, blah, blah, blah. All right, the one I want to show, amount for unreimbursed medical expenses, yep. Health insurance premiums paid while unemployed, not from a 401k, but from an IRA. So that's of interest. So one of the issues, if you get health insurance premiums while unemployed, you might want to roll over your qualified account to an IRA to be able to tap that into without having to pay the 10% penalty. Some certain military distributions, yep. Return IRA contributions, yep. Rollovers, you're rolling it from one plan to another as long as there's a certain time frame and it doesn't show up to you outside that certain time frame, you're fine. This is a big one. Separation from service. You see a big fat yes and a big fat no. No is IRA. Separation from service is exceptions to the 401k, 403b, TSP. Qualified plans. Qualified plans being plans that are under ERISA, the Employment Retirement Income Security Act of 1974, I believe. All right, so let's check this out. The employee separates from service during or after the year for which he turns 55. Notice I said he, all right, because we're still toxic masculinity here at Heritage Wealth Planning. He turns 55. Age 50 for public safety employees of a state or political subdivision of a state in a governmental defined benefit plan. Interesting, huh? But anyway, so we got the employee separates from service during or after the year for which the employee reaches 55. Notice, not from an IRA, however, only from a qualified plan. Interesting. Now you have two asterisks down here, so let's take the two asterisks. Qualified public safety employees, effective for distributions after December 31st, 2015. The exception for public safety employees who are age 50 or over is expanded to include specified federal law enforcement officers, Custom and Border Patrol protection officers, federal firefighters, and air traffic controllers. Also, the restriction that only defined benefit plans qualify for the exemption is eliminated, thus your TSP. Thus, an exemption is allowed for distributions from defined contribution plans or other types of government plans such as TSP. So remember, this right here, public employees of a state or political subdivision of a state. That would be deputies with sheriff's department, for instance. As long as you're after the age of 50 or after the age of 49, and you separate from service and you keep your plan in your TSP, the 403B, the 401k, was a 457 plan? I'm not sure if public, I don't know how that works. There might have one. But as long as you keep it as a qualified plan, all right, you can have access to that money post 49 years old if you're a law enforcement officer from a federal or a state political entity, even a county, because sheriffs of the county. I'm telling you, man, it's a big deal. So remember, so the guy had emailed me just a few minutes ago. He said, hey, man, my wife's a teacher, 55 years old, and we want to have access to the money before, so she doesn't have access to the 10% penalty. There you go. I emailed him this link right there. This is huge. I tell you, man, I probably should do another video just solely on public safety employees, because I did a video on that a long time ago, probably 2 years ago. Probably need to do it again. It's huge, a huge benefit. So hope that helps, my friends. You have some exceptions to the 10% penalty. It's very lenient in a lot of regards, especially if you're a law enforcement. Remember, though, if it's an IRA, no. If it's a qualified plan, yes. Hope this helps. Love to hear your comments. Thanks now.